Well, hello everyone, and welcome to our ethics webinar today that qualifies for Circular 230 ethics requirements. It also qualifies for Michigan State Board of Accountancy requirements for CPAs. I'm very happy today to have with us Alan Scioli and Susan Scioli from Scioli & Associates, who are our presenters today. Before I introduce our presenters, we need to just go over a couple of housekeeping chores. Want to ensure that everyone on the call understands that to earn CPE today, you must have logged into the seminar using your unique link that you received when you registered. If you have multiple people viewing this webinar from one computer and those people have not individually logged into the event, only the individual logged in will receive credit today. So please be sure that you have logged in, whether you're on that computer or you're sharing a computer with someone else in another room. Make sure you've logged in so we have a record of your attendance. In order to earn your 2 CPEs, you must remain on for the duration of the webinar. And upon completion of this webinar, we will email a certificate of completion to you using the email address that you provided when you registered for the webinar that you will keep for your records. We will then upload CPEs earned into your PTIN account prior to December 31st if you have provided us with your PTIN number in your registration for today's event. If you have any questions about that, there's a chat box on the left side of your dashboard where you see it says chat. You can ask us questions there to answer them. If we can't answer them, we'll give you a telephone and give us a call to make sure that you get those 2 CPEs. As I said, there is a chat box on the left. You can use that to pose questions for the presenters. If we can answer those questions as we move through the presentation, we'll do so. If we can't, then we'll hold off until the end of the webinar to answer those questions. I did want to let everyone know or draw attention to your chat box. You can see that I've listed our website address at iam.net. If you would like to download and print the presentation for today's ethics webinar and follow along with that, you can do so. What you want to do is click that link. That'll take you to our website, and in the box on the right side of the home page, you'll see the ethics webinar listings, and right below those listings, it'll say download of today's presentation. You just simply click that, and you can download and print that if you want to follow along that way. Just want to stress that's not necessary. That's only for your convenience. So I'd like to introduce our presenters today. First is Susan Scioli. Sue is a former IRS Field Assistance Tax Specialist and an IRS Senior Tax Specialist for the SBSE Tax Education Division of the IRS. Susan has vast, in-depth tax law training in multiple disciplines, from fiduciary returns to the new tax acts. Nationally acclaimed tax lawyer and travels the country as an invited guest for several nationally recognized organizations, and is on the faculty and staff with Michigan State University as an instructor for the practitioner forums that travel the state teaching CPAs, attorneys, and enrolled agents new tax law legislation and complex tax topics. Alan Scioli is a former Field Assistance Tax Specialist and Revenue Officer with the SBSE Division of the Internal Revenue Service. He's been involved in federal taxation arena for over 14 years and the U.S. government. Alan is a specialist in IRS offers and compromise, has saved clients millions of dollars with hundreds of approved offers. Additionally, he has served as an expert witness in many state tax tribunal cases, U.S. bankruptcy and district court cases, and U.S. Department of Justice cases dealing with the tax division. Together, Susan and Alan formed Scioli & Associates, a tax representation firm in Saginaw, Michigan, nearly 10 years ago. The firm expanded in 2012 by adding an office in Muncie, Indiana. In 2013, the team formed Tax Representation Done Right, a web-based tax representation resource designed to help tax and accounting professionals develop IRS representation skills that can generate year-round revenue. We encourage you to check them out both at scioliandassociates.com or at taxrepresentationdoneright.com. And with that, I am going to turn it over to Alan and Sue.
Hey, thank you very much, John, and thank you, IAAM, and everybody for allowing us to have this ethics webinar. Sue?
Good afternoon, everyone. Good afternoon, John. I wanted to just tell you that Al and I are both very excited to be part of the presentation today, to have an opportunity to have this discussion with everyone. Jumping right into the topic of the day, we're going to be talking about ethics, and we're going to be talking about Circular 230 and the ideology behind what we as tax professionals are supposed to be doing. Really, what is the role of a tax professional?
Additionally, we're going to try to give you guys some real-life examples and try to keep it upbeat and try to keep it, ethics sometimes can be a kind of a dry subject, so we're going to try to add some real-life scenarios in this.
And as John said, we are more than happy to answer any questions that you may have, so please feel free to utilize that chat box and give us some questions along the way, and we'll do our best to answer them during our time frames, and if not, we'll make sure we're getting back to you still even after that. When we start to talk about the role of a tax professional, I think it's important for each and every one of us to understand that the clients are hiring us as specialists, as individuals who know and understand the tax law. And our job really is to zealously represent our clients. And representing our clients includes the preparation of that tax return. It really means a lot of times asking enough questions to get to that right answer. So many of our clients don't understand tax law, and because of that, they may not know what information they should be giving us, what documentation, what records, and so it really becomes our job to zealously do this and to follow through by asking them the right questions to pull that information out of them.
And you're absolutely right, Susan. And what is zealously representing? We're going to go into that, but defining it is really intense diligence, to be actively and ardently devoted. That is the actual definition of zealousness. And why is that so important for us to know? Because there is a fine line when you're preparing tax returns or representing your clients as to going over that line of zealousness and what is the scope of zealousness, so we don't get ourselves into trouble with Circular 230 issues that we'll talk about specifically down the road. The IRS right now is expecting us as the practitioners to pick up the slack. More and more onus is being put on the practitioner to not only detail and diligently review client records and to ask the proper questions to dig in detail, but they're putting that scope and focusing on us as practitioners that if we don't do that, we're going to run ourselves afoul of the rules of the 230.
Right, and they have put a lot of different rules in place over the last couple of years, some of which are being challenged right now under the Loving case still. But what it comes down to at the end of the day is that we as practitioners have to know what we can and can't do. Back when I worked for the government, I was one time teaching a seminar to a bunch of practitioners in New York, and one of the practitioners asked me if we were really allowed as tax professionals to zealously represent a taxpayer in something like a like-kind exchange. He said, are we crossing a line telling somebody to do these different things and then they're able to avoid paying tax? And my answer to that, whenever somebody asks me about tax planning, is there is nothing wrong with tax planning. There's nothing wrong with protecting our clients and showing them the best way for them to be able to pay the least amount of tax that they are legally responsible for paying. And that's why I think where Al's referencing, that fine line. We absolutely should be looking for every legal deduction and every legal opportunity that we can for that client for tax planning purposes, and that's why the laws are written the way they are. We should not ever obviously cross that line, and so that's kind of the difference that we're going to take a look at a little bit today.
Susan, that's exactly right. Clients don't understand the law. That's why they're hiring us. They don't understand the critical processes that go involved and the requirements that the government has not only on the taxpayer, but also us as the practitioners. The IRS updated its mission statement in 2008, and it used to be something different that said, paying the fair amount of tax. They kind of consolidated and generalized it, and the new IRS mission says that to provide America's taxpayers top quality service by helping them understand and meeting their tax responsibilities by applying tax law with integrity and fairness. Now, the key in that one is by providing top quality service and helping them understand and meet the tax responsibilities. And this is where it's shifting more and more over to the practitioner to help them understand and meet those obligations.
Right.
Sue?
And absolutely. Our job is very similar to the IRS's mission. It is our job to make sure that our clients understand what the tax laws say. That's why it's so important for us to sit down and explain a tax return to our clients before we would ever ask them to sign it, because they should understand the basics of what it is that we're doing when it comes down to that tax return. I think one thing that's also very important for us to always keep in the back of our mind is that we have our clients sign these tax returns under a penalty of perjury. And most practitioners that I spoke with during the years that I worked for the service and did a lot of education didn't understand that same perjury statement applies to us as the practitioner when we are signing that tax return. So you'll notice on the PowerPoint, we actually have that there. Under penalties of perjury, I declare that I've examined the return and the accompanying schedules and statements, and to the best of my knowledge and belief, they are true, correct, and complete. It is so important as a practitioner that we ask enough questions to get to that right answer so that we can sign that tax return under penalties of perjury knowing that it's correct. If we haven't asked enough questions, if we have gotten answers that are inconsistent with the tax return, we have to change our game plan. And we can't turn a blind eye to something that the client is telling us, and we certainly cannot allow the client to tell us information that is off the record and then not take that into consideration when it comes time to prepare that tax return.
Sue, also what I try to point out to a lot of practitioners out there that try to help or even represent their clients out there as well is that when you look at this penalty as a perjury statement, it says statements. What is a statement? Well, the statement is defined very specifically in the Circular 230, and the IRS very clearly takes that as any type of statement, affidavit, documentation, financial statements. So those that are actually representing their clients or preparing the IRS's financial statements, the 433As, the 433Bs, offers and compromise, those types of things, also applies. This is considered a statement. So if there's something that is misrepresented, knowingly misrepresented by the preparer doing these types of work, in addition to normal tax return preparation, they can also be subject to those penalties if they fail to properly adhere to those standards. Sue?
Absolutely. When we talk about the standards of practice, we talk about Circular 230. I don't think that there's an ethics class out there that you could sit through for a couple of hours and not have us actually circle back and discuss what the Circular 230 really means to us. When we start to talk about a Circular 230, we have to understand really what it is. There are practitioners that I've spoken to in the past that have said they've never actually sat down and looked through a Circular 230, and I always warn them that they need to spend that time to understand what this document is. The Circular 230 is our playbook. It's our instruction manual, and it is what we are required as practitioners to adhere to. It is irrelevant what kind of licensing or recognition you have, whether you are an unlicensed tax professional, if you're a registered tax return preparer, whether you're an EA, a CPA, or an attorney, we are all bound by the Circular 230. And so that is the instruction manual that we have to follow. It is our standard of conduct. A lot of times I like to tell everybody a story that I have from when my son was young. When he was only 5 years old, he was in his second year ever of playing baseball. And at 4 years old, when he first started playing baseball, he was the typical 4-year-old, and they were running around the field and picking grass and sitting down and, all that great stuff. At the age of 5, they had a new coach that really wanted to start to teach the boys the rules of the game. And so there were certain practices where he would really spend time with the boys trying to explain the different rules and why we had to do different things when we were playing that game. And my son was the typical 5-year-old. He wanted nothing to do with that. He wanted to be out there playing in the field and hitting the ball and running the bases and having a great time. And he didn't understand the importance of those practices. So we got to one of his first games, and he's at the game. He was up to bat. He hit the ball way out into the outfield. He was so ecstatic that he had done that, and so he went tearing through first base. And once he made it through first base, he circled back into the diamond as he was trying to see where the ball was and how far it had gone and everybody's acknowledgments of what he had done. And he wandered back to first base. Well, what he didn't understand was that the minute that he had circled back in and started looking around, he was live again. Everything was back live, and he ended up getting tagged out. He didn't understand that he needed to circle out and come back around to the base. And so, as a 5-year-old, he's standing on first base. We're telling him that he's out and he has to get off. He does not want to get off of first base. He thinks that he is still there and he made it there fairly. So he's, a typical 5-year-old boy. He didn't want to cry. He got tears welling up in his eyes, and he's having to come off the base. So I pulled him off to the side, and I asked him, what did you learn from this? Now, his first response back to me was, I don't want to play baseball anymore. Okay, which, was typical, I guess. Once we got past that point, I said, what we learned from this is that we have to understand the rules of the game. Once we understand what the rules of the game are, we can adhere to those rules. Any one of us in society, once we understand what the rules are that we're required to follow, we have the ability to follow those rules. And that's where the Circular 230 becomes so critically important for us, because that is our rule book. And if we don't understand the rules of the game, then how are we supposed to follow them and adhere to them? We could be turning left when we should be turning right because we don't know that we're supposed to be turning left. And that's the whole point behind any ethics class, in my opinion, that we need to understand. What does the rule book say we are supposed to be doing?
Thank you, Susan. And for everybody out there, we did provide the Circular 230 link very specifically, and there was a bunch of substantial revisions as of June 3rd, 2011, that were effective as of August 2nd, 2011. So there is a link there that you guys can utilize, and we encourage you guys to take a look at that. And we're going to talk about some of the sections in the 230 and real-world application as we go forward here.
Absolutely. So I guess, the first thing that I always like to really talk about is what does the Circular 230 cover? A lot of times you'll hear people say, well, the Circular 230 covers practicing before the IRS. And their point that they will make to me is, well, I only prepare tax returns, so I don't really represent taxpayers before the IRS. And what everyone needs to clearly understand is that practice before the IRS includes tax return preparation. Anything we do that has to do with that tax return, any liability, all of those things become part of that practice. And on the PowerPoint, what we've given you is some of the definitions that the government uses in some of their recent guidance. What they tell us is that practice includes all matters that are connected with the presentation to the IRS relating to a taxpayer's rights, privileges, or liabilities. What is a liability? That's the tax return, right? That's how we present the liability to the IRS, is through a tax return. So it's talking about that under laws or regulations. They go on to also say preparing or filing documents. So that, again, that includes a tax return. Corresponding, communicating with the IRS, rendering written advice, and representing a client, conferences, hearings, or meetings. So even a letter that we send into the government after our client's tax return is filed and the client gets a notice saying that they've disallowed one of the dependency exemptions. And so we send a letter to the government The minute that we are doing that we are corresponding, we are practicing before the IRS. If you call the IRS and say, hey, this is the notice and this is what we need to do to resolve it, you're communicating with the IRS, which means you are practicing before the IRS. So this huge misnomer that tax return preparers don't have to adhere to this needs to immediately be disarmed.
Sue, you're absolutely correct. And again, I'm going to jump over to the representation side and talk about hearings and meetings and conferences. Even when we're not presenting a document, or we are just speaking or representing a client at a meeting or a hearing or calling the IRS on the phone, the practitioner service, and providing information to them, that also is considered practicing under the rules of the Circular 230. So anything that could be told to an IRS assister on the phone, or practitioner priority services, or the automated collection service, or any one of those outlets of the phone bank people also constitutes a practice under Circular 230, and we have to be conscious of that fact and know the rules, just like Sue said.
Right.
One of the things, Sue, that I wanted to ask you is, we always hear, well, what if I'm just the one preparing the tax return in my office, but gee, my boss or my principals in my firm really is the one that signs the firm? I can't be held responsible for that, right?
Yeah, Al, that's a great question, and I hear it at almost every ethics class that I've ever taught. And the answer to that question is anyone who was involved in the preparation of that tax return is going to be held responsible. So if someone is only preparing part of that tax return, then they are responsible for any information that they have provided for that return. The principal, being the person who signed the tax return, actually becomes responsible for the entire thing, because there is a understanding that before we are ever to sign a tax return, we're supposed to review it for accuracy. So the minute that someone signs it, they're taking on responsibility of every entry on that return. But every person is going to be responsible for any input that they made into that return as well.
So you're saying both people would be fully responsible?
Absolutely. Both people would be responsible. And if there was a problem in a circumstance later on where the government came in to reprimand or sanction or penalize, they can literally penalize both individuals for their part of that tax return.
Oh, that's very interesting, sir.
Okay, so let's talk about some of the sections within the Circular 230 and some of the areas where there tends to be some misunderstanding and where the penalties tend to come from when you start to look at what OPR, which is the Office of Professional Responsibility, actually publishes as far as who did what during the year. The first issue that's talked about in here is the IRS request of records. And when we're talking about an IRS request for records, what we're talking about in that circumstance is the fact that the IRS is going to ask us for information. And the way this comes down to is that when the IRS is requesting information from us, we as the practitioner we're responsible for providing that information in a timely manner, promptly submitting any information that they are lawfully entitled to receive.
And Sue, I kind of wanted to jump in a little bit and define the lawfulness of things. And a lot of people ask us, well, what is lawful, what is not? What if I have an IRS auditor auditing my tax return that I prepared for my client, and he's asking me for information that has nothing to do with what I'm, auditing, like the 1040. My client has a corporation, and that agent's asking me questions on the corporation. Is that a lawful request? Well, my answer to those people is, look, you always want to be cooperative and professional with the IRS. That's important. We get more with a teaspoon of sugar than we do a pound of flesh. But that zealousness needs to kick in. And the zealousness is that you have every right to ask an agent or officer of the IRS how the request is relevant to their case. And by noting that and bringing that issue up and making sure that you document it in your case file as you're going through, you're really doing the right thing by zealously representing your client. And a lot of times when you do that and you ask specifically from that agent or officer, hey, what is the reason for your request? Sometimes they'll understand that you are asking a very detailed question to determine if it was a lawful question or not. And they may abandon that question, and thereby you really have helped your client. You have every right to keep the scope of a review, a scope of questions from the IRS, even from an assister, from the ACS unit, from anybody within the IRS that's considered an official government official, when being requested lawful information. This really boils down to when that person has the jurisdiction over that tax return, let's say in an audit situation, and they request data about the return that's a lawful request. Then we should not be impeding that. We should not be interfering with that as long as we have that information in our repertoire, then we can certainly provide that information to them. Sue?
Right. And so the, lawfully requested information, like Al is saying, is just that. We have to make sure that they have a right to that information. So I think, we have to always remember, we don't just turn over everything that they ask for. We should be asking questions as to why, if we don't think that it is something that's relevant to the matter at hand. We also talk in here about the fact that it's something we have to turn over unless it's privileged information. So we need to make sure that practitioners understand as well that the attorney-client privilege that protects confidential information of the client does extend to us as practitioners under what's Internal Revenue Code section 7525. What it tells us is that same type of accountant-client privilege protection is afforded to us. So we have to make sure that if there is information that is privileged in our file, that we understand that information can be held back.
And we have a duty to zealously represent that client and protect that privileged information. Sue?
And so when we talk about what privileged information is, we've got to make sure that we understand that. Privileged information is anything that the client has actually told us at the time that they're turning it over or the conversation is taking place, that this information is to be considered privileged. Okay. Now, there are some things that aren't going to be privileged information, like our work papers. As we start to prepare a tax return and we've got our work papers, those are not considered to be privileged. But it is the documentation or the communication when a client has specifically said this information is to be kept privileged.
And that privilege is designed, the purpose behind it is designed to allow taxpayers to come forward to us as tax professionals to tell you everything, to fully disclose the information in order to be in a better position for us to guide them and be fair and do it with integrity, just like the IRS mission says. So the government gave that 7525 code to us recently in the last couple of years for the purpose of allowing taxpayers to be free to openly discuss and disclose information to us. If we fail to take an opportunity to discuss and determine and get that information disclosed from clients, then we've kind of done a disservice to our clients in that effect.
Yeah. And when we talk about this information, it's really allowing our client to be candid with us.
Right.
Now, I do want to make sure that we're also clear in stating that it doesn't mean that we can turn a blind eye to that information that is privileged and not have to reflect itself properly on the tax return. We still have to take all that information into account when we are ensuring that we have prepared an accurate and complete tax returns. We can't pretend we didn't hear it. It is just privileged information that we don't ever have to turn over to the government in a normal circumstance like this.
That's exactly correct. And let me give you some real-world examples, Sue, of some of the questions we see that when we're traveling out or we're representing our clients. I get a lot of CPAs, accountants, EAs, even some of the return unenrolled prepared people ask me, say, hey, look, I've got an IRS person asking me for all my QuickBook records, all my electronic data. Do they really have to turn that over? I can't believe they'd ask me for everything. And that's something that just came about recently. And in 2011, April 20, 2011, the IRS did come back with some clarification.
Yeah, the AICPA asked the IRS for some clarification when this new procedure started happening where revenue agents would ask the practitioners for a client's QuickBooks file as they were beginning to start with an audit. And so the IRS came back, like Al said, in April of 2011 with a response. And basically what they said is that the initial or the original request for the information needs to be honored. And so what they have provided is kind of a little background and understanding is that the concern, of course, for those of us aware with how QuickBooks works is that when we have a QuickBooks file and only 2011's tax return is under audit, there's not a way for us to just extract 2011 and hand that over as QuickBooks. Now, obviously, we could pull reports and things, but that's not what the government's saying they want. They want actual access to the QuickBooks file.
Yeah.
And so what we would really be doing is turning over to them everything from the day that company opened or that QuickBooks file opened all the way through that 2011 tax year and current day too if we're into 2012 or 13 at this point. So that was the concern. So what the IRS had explained is that you could always do a backup. And so you could back up the client's QuickBook file at the end of each year to reduce what would have to get turned over in a circumstance of an audit. So what they really mean by that is literally every year we would be starting a new QuickBooks file for our client. And then at the end of every year, we would just be transferring over accounts receivables, all those types of things. That's obviously incredibly burdensome for a taxpayer and a practitioner to have to be doing on an annual basis, so not very realistic. The other option that they gave was that we can condense or archive the older years so that that information is not something that would be given in detail to the IRS before we hand over that QuickBooks file. The problem there, at least previously, and I know that QuickBooks is trying to work on resolution to some of these issues, but previously the issue was that once we've condensed or archived that information, we can't pull that information back apart again if we were to ever need to get back into those files for some reason. So, there are definitely some issues and some concerns, but the bottom line needs to be very clearly understand that when the IRS is requesting these types of records, we are required under the Circular 230, Section 10.20, Pren A, Pren 1, to provide that information unless it is privileged, which of course this would not be.
Absolutely, Susan. I couldn't agree with you more on that. Now, in the real world, too, I want to make sure you guys all understand that when that's asked of us, we still have the right. We still have the right to limit the scope of the IRS and to ask the questions of the agent of exactly what they need or to try to dissuade them from getting the whole record. There's been many times where we were in an audit, specifically and with one of our clients, where this voluminous request was made, and we had a general ledger that was more than 3,000 or 4,000 pages through a QuickBooks, and we knew by just merely turning over the QuickBooks file in its entirety, it would have substantially delayed the process of the audit that we were going in. That's not what the client wanted. It would have cost substantially more, and the amount of information that was there would have been turned over to the government could have caused just an enormous amount of time and cost to the client going forward. There is nothing wrong with us as practitioners zealously representing by negotiating and trying to limit the scope, cooperating, saying absolutely we'll turn over everything that you want or that you have requested as it relates to electronic file. But Mr. Revenue Agent or Mr. Revenue Officer, what exactly is it that you're looking for that I can provide to you probably in a quicker and break it out for you easily to find it, or let me help you extrapolate that information and I can provide that instead of having you wade through 5,000 pages of my general ledger or the QuickBooks file. Right. So don't forget that we have a right to limit the scope. It's not just jumping in and, oh, they request it, therefore we blindly give it out. There's a give and take. You can negotiate, okay? Now, again, that agent has the right to say, absolutely not. I want 100% of your QuickBook records. At that point in time, we must provide that data as requested. We must comply with that lawful request in that circumstance. But nothing says we can't limit scope, we can't zealously represent, we can't offer other alternative ways
Right.
Sue?
Right. And you know, we want to make sure that we stay on top of recent QuickBook revisions and newer QuickBook revisions because, as I said, QuickBooks understands that this is a problem and was a concern, and they had made a promise to their customers to do what they could to resolve this going into the future. So maybe it's time for you to update your QuickBook files and update your QuickBooks software so that you have the newest revision and the newest version, and that may have some provisions in it that would help to resolve some of these concerns or issues. One last thing I wanted to talk about on this topic is dealing with records that aren't in our control. Sometimes the government will ask us for information that we simply don't have or our client simply doesn't have. And when that happens, we have to make sure that we do notify the IRS right away that we don't have that information or our client doesn't have that information. But if they are records that are still required to be kept, let the government know where those records might be or who may have those records so that they can follow through and obtain those records from the other source. This happens sometimes with businesses. Maybe the business has gone out of service, they're no longer open, and there were two partners. And maybe one of the partners has been contacted by the IRS and asked to provide some of the business records. They don't have them, but they know that the other partner does have them and they're being stored off-site in some storage warehouse or something. That would be that type of a circumstance. And open communication and making sure that we're providing things in a timely manner is really what's key there.
And Sue, I have another real-world example in that circumstance where we were dealing with a collection matter. And it was a circumstance where they were requesting an entire year of bank statements that my client only had partial bank years, and the bank had previously been bought out 2 different times. So the time, energy, and cost of that client to turn over that document would have been substantially delayed by us, not intentionally, just because of how difficult it was to get the records. And we communicated properly to the IRS revenue officer that was assigned to that case. We were lawfully advising him of what we did and did not have because we only had partial months and not partial months. And the resolution to that came to be, in limiting that scope, is that the IRS summons those records directly from the bank. We actually requested it to be done. So we saved our client a ton of money just by not having him to have to come forward and to provide those documents. So the point we're making here is make sure you guys as practitioners are communicating properly with the IRS, that we're coming forward and letting them know that what we do or do not have, not unreasonably delaying them. In this circumstance with the bank statement, giving them 3 months, not telling them we are having problems getting the others because of the banks being closed and bought out. And, you know, you're going to win-win on both sides. A, you're complying to the Circular 230 requirements, and 2, you could save your client some money. And it shows good cooperation on your end to the government.
Right. Absolutely. Absolutely. Let's talk about the actual time that we should have when we're working with the government to turn information over. When we're talking about making sure that we are not delaying any type of matters, that we're not causing unreasonable delays, and that we are turning information over in a timely manner. When we start to talk about these types of issues, we're referencing Circular 230, Section 10.23. And again, basically what it is telling us is that we as practitioners cannot unreasonably delay the disposition of IRS matters. Now, that doesn't mean that we have to turn everything back over within 24 hours. The government has to be reasonable in their requests and the time frames that they allow us to get documentation over to them. But we also have to make sure that we are being diligent in trying to meet those deadlines. If we are working with a revenue agent or an officer or anybody within the service and they've asked us for something and we need more time, open communication with that person is really the key. Letting them know why we're going to need some additional time and being very conscious of how much time you're asking for. Don't ask for a couple of days if you know that the bank has told you it's probably going to be 2 weeks for them to be able to get those documents to you, because then you're constantly having to call and ask for more and more time. just be upfront. Let them know that we're waiting on the documentation from the banks, or, you know, we're waiting on the secretary from the office to be back from vacation. She knows where the records are. We'll be able to get them much more quickly if we're able to get it in a couple of weeks, so she gets back and then has time to pull those documents. An understanding is what we really need to make sure that we are giving the service. So again, prompt disposition is obviously important, but there's got to be some give and take on both sides.
And I couldn't agree with you more. And in real life, what we see, Sue, with a lot of the practitioners when we talk to them, and they tell us, yeah, you know, the IRS revenue officer gave me a week, or, you know, I asked for a week, but really I couldn't get it done. I didn't want to piss him off, or I didn't want to frustrate the agent. You know, you guys got to realize, don't feel under duress to make things or get things quicker than you need to be when it comes to the IRS. I say the opposite to my clients, and when we talk to accountants and practitioners, always request the maximum time. If you think it's going to take 2 weeks, ask for 3 weeks. If you think it's going to take 4 weeks, ask for 6 weeks. The IRS will come back and say, you know what, that's unreasonable. I have to have it done by this. But the dialogue will open at that point in time, and sometimes you'll get insight as to what the agent's looking for, if it's a return that you prepared or so forth. The other thing that I say very critically here, and this is to protect us as practitioners and meet the requirements of the 10-23 under the Circular 230, is that you've got to make good notes of your calls, the times, and when you requested these extensions. So many times, even earlier in the representation, what we saw was that a lot of CPAs and accountants, and tax professionals, when they would talk to the IRS, they would say, well, I requested, you know, time to do this, and it was ambiguous. Well, I need a couple days. And a couple days to the practitioner was 7-8 days. To the IRS, it was 2 days. And then the practitioner runs afoul of the IRS agent or officer coming forward and saying, you didn't properly supply the documentation in the proper amount of time. Be very specific with the people that you're dealing with. That's your job as the representative, to make sure you're limiting scope and controlling proper dates that are required of you. And that is communicating both ways with your client, talking to your client. If you don't have an answer, if you don't have an answer and that person from the IRS is the authority, asks questions, and you don't have an answer yet from your client as to how long that document's going to take, there's nothing wrong with saying to that agent or officer, look, I can't give you an answer today. Give me a day or two to get a hold of my client, and then we'll reconvene, and I'll tell you what we can do or what time frames we can come up with. So again, we stress cooperation. We stress taking good notes and documents, because look, if you don't document that you spoke to a person at a certain date and time, you're not going to remember it a month or 2 or 3 down the road. So we stress that, and we stress the limiting of the scope of that communication with the IRS for the benefit of your client. Again, zealously representing.
Okay. And Al, I couldn't agree with you more on all of those points. I had a practitioner contact me just recently on an issue that had to do with this. They had contacted me and said that they had a revenue agent who had just made contact with them. They were opening up an audit, and they want to meet with the practitioner for their initial meeting for this audit on January 20th. And the practitioner asked me, you know, can they do that? Can they really do this right in the beginning of tax season? I mean, this guy's telling me that he's going to take 3 or 4 months of needing to be at my office several times, and the revenue agent wants to do this right as tax season is getting off the ground. This gentleman that I was talking to is a sole practitioner. He's got one girl at his front desk that answers phones and directs traffic as clients are coming through the door. He is the only practitioner. He is the bread and butter maker within that firm. And so if he has to take time during tax season to be able to work with this agent, it is just going to create major havoc. And so his question is, can he really do that? You know, the IRS used to have a policy that they didn't hold audits during the tax season. A lot of revenue agents actually used to get shifted and put into temporary details and other job positions within the government to assist so that they weren't burdening the practitioners during tax season with audits. But those days and times have long gone, and now the IRS and the revenue agents in the audit fields work year-round in those types of systems and programs. So can a revenue agent ask to have those meetings? Absolutely they can. Can we as a practitioner ask to have that pushed off until after tax season? Absolutely we can. And that is not unreasonably delaying things when we have an explanation, such as this gentleman does that I was talking to just the other day. When he explains to the revenue agent that he is a sole prop, that this is what it's going to mean for him, that he can't take this much time and effort and energy during tax season, then that revenue agent absolutely should work with him, and nobody should try to tell him that he's unreasonably delaying.
Now, Sue, and I couldn't agree with you more when it comes to the examination side. I want to kind of give my audience a little perspective on the collection side. Collections is a little bit of a different animal when you're dealing with your clients in that regard, whether it be a notice or something to that effect. A lot of the collection sides are more statutory, meaning more legally intensive as far as how long the officers are allowed to hold the cases, and some of the just normal statutory notices that are issued out, like a 1058 letter or an LT11 letter, which are final intents to levy. So there are some automated processes that we as practitioners can't really work outside the boundaries with, okay? We can more on the examination side. On the collection, it's a little bit more different there, a little bit more time intensive. But that still doesn't mean that we can't still, even on that side, limit scope if we're dealing with the revenue officer. They do and are held accountable more for the time frames that they hold inventory in their caseloads. And that is something that the practitioner community needs to be aware of, that can have a detrimental effect if we don't respond. Certainly, simply just avoiding someone's phone call, whether it be any IRS person, would, over a period of time, and I say, 4 or 5 times where you're just not returning a phone call or anything to that effect, would be construed as an unreasonable delay. And any type of agent or officer, after a 3 or 4 time, will certainly be documenting every call and has the right to bypass that third-party person who prepared the return or a power of attorney that's assigned to the case to represent them. So we want to make sure there's a distinctive line here that we can always work with both sides, but there is that fine line where if we just bury our heads or we say we're too busy and we don't communicate with the agents or officers, that we can run afoul of that law and not only be held to unreasonable delay under the Circular 230, but they have the right to send a referral to OPR under that issue alone.
Right, and when Al's talking about bypassing a practitioner, that is a referral that does go to OPR. Bypassing is basically when an IRS personnel is going to go to their manager and say, this person isn't working with me. They're creating problems. They are unreasonably delaying things and the prompt disposition. And then the government sends a letter to us as practitioners saying, we are going to bypass you. We are going to set you aside and now begin to work directly with the taxpayer again to try to get this moving. You absolutely have a right to argue that point. If there has been some phone calls you've left or messages that you've returned, or you guys are playing phone tag, or there was a reasonable explanation, you were in the hospital or a family member, something like that, then immediately that bypass letter needs to be addressed back in writing to the IRS personnel to show that there was no intent to unreasonably delay or create a problem, but here is the explanation of what happened.
And Sue, that's an example that I tell everybody all the time. It must be in writing. You must issue it to not only the OPR people to respond to them, but I also would document it and issue it in my file and send it to the revenue officer or agent that wanted to bypass me.
Right.
Sue, what do you do in the circumstance when you have a client that unreasonably delays? That
right.
It has nothing to do with you. You're calling the client, but you just can't get this client to cooperate. How do we handle that?
Well, and Al, that's a great question, and it happens sometimes. And sometimes those are the same clients that then all of a sudden we're getting a bypass letter on. And one thing we have to understand is that bypass letter also goes out to our client. So not only are we having to now damage control and show the IRS that we had a reasonable purpose and an explanation for what was going on, but now we've got to damage control our client getting a letter that makes it sound like we weren't doing our job. So what do we do when the client is the problem and they're the ones that are delaying? We need to have a conversation with that client. We need to document when we are trying to reach them. We need to document when we are asking them for information. And there are going to be times that we're going to have to disengage that client because they are being uncooperative and making it impossible for us to actually further their case, move their case along, and assist in getting prompt resolution. And in those circumstances, disengaging the client is really what's going to have to happen. When we are disengaging a client, it's important that we are withdrawing our POA or revoking our power of attorney with the government. And to do that, you're going to fax a copy of the power of attorney that's being revoked to the centralized authorization unit where you normally file it, but you also should be sending a copy of that to the IRS person that you have been working with. If it's a revenue officer, agent, appeals, whoever it is, you should send it out. What we do as a policy in our office is we use a fax cover page that just simply explains that we have revoked our power of attorney for the following client or for the attached client. We are no longer engaged to represent them as of the following date. And then we also let them know client is aware of any deadlines that have been set or any documents that are due, and then we attach a copy of the power of attorney. By doing that, that is documenting in our file that we have notified the IRS that we are not unreasonably delaying or not cooperating. We're simply no longer engaged to represent. And now that IRS person knows that it's not us or we're not the problem, and they don't continue to try to call and reach out to us without answer.
And Sue, we had a case very recently within the last year where a practitioner was hit with an OPR letter questioning that circumstance with a bypass because that exact circumstance happened. They had sent in a request to the IRS CAP unit to revoke their power of attorney, never told the revenue officer. And why it's important that we tell the revenue officer, because the revenue officer never checked his system to see an update on the power of attorney. He had it in his record. They were working together previously. The power of attorney then disengaged via a revoking of the POA, and it was a miscommunication. So that power of attorney was sitting here getting a letter from OPR because the RO was never informed he disengaged, and it was a simple matter to clear up. But the point being is that it could have been an easier matter not to even have an OPR inquiry had he simply just provided a copy to the revenue officer and explained he was no longer representing that client.
Absolutely. Absolutely. I couldn't agree with you more, Al, and that's why that open communication is so important. And like Al said earlier, documentation. We've got to put the documents back in our file to prove that those types of communications have happened.
The burden is on us as practitioners, folks, so we have to be diligent.
Right? Okay, so let's talk about the client's information. If we know that or become aware that something is incorrect on a client's tax return, what do we need to do is really the question that comes about here. So Circular 230 tells us that when we are dealing with clients' tax returns, if we become aware of a problem with the return after the fact, we still have some responsibility. Let's talk first about that tax return that we did not prepare. You have a new client that has come through the door. You're getting ready to prepare their 2013 tax return, and so you've asked them to bring the last couple of years' returns in so that you can kind of get a baseline of what's been going on in the past. As you're reviewing the 2010 tax return, let's say, you find a mistake on that return. Even though we didn't prepare the return, we still have an obligation to our client to tell them that there's something wrong with that tax return. Again, that is what they are paying us for as specialists. We've got that obligation. Now, if it is going to generate a refund, obviously we're going to have that discussion. If it's going to create a balance due, we still need to have that discussion with the client and making sure they understand what was wrong and what needs to be done to have it corrected. And then you leave it to them to make that determination of whether or not an amended return is going to be filed. You recommend it, you tell them that it should be, you let them know there's additional tax that would be due, explain penalties and interest continue to accrue until it's paid, and then you leave it up to them to make that ultimate decision. But one of the things that we also need to understand is that now that we know that there's something wrong on that 2010 tax return, as we prepare the 2013 return, we need to make sure that we are preparing an accurate return. So let's say that the mistake on the 2010 return is a depreciation error. Let's say that they're not taking depreciation on an asset that should be getting depreciated. Or let's go the opposite and say they're taking more depreciation than should have been. As we go to prepare the 2013 tax return, we can't continue to take that accelerated depreciation at a rate faster than it should be. Now that we know that it is incorrect, we have to file an accurate 2013 return. One of the options sometimes is to explain what has gone wrong in the past with the client, and if we're able, try doing a Form 3115, which is a change of accounting method. Attach that to the current year return to make those types of corrections like depreciation, or maybe we've got a carry forward of something else that's been being done there handled incorrectly. If we can correct it with a 3115, that avoids having to prepare a bunch of amended returns, and we can get it resolved that way. So that's the kind of the first scenario of when we haven't actually been the one that prepared that first return.
Sue, one of the questions I always hear from practitioners when they get a new client and it's one where they look at the return and it's horrible is, hey, should I be turning in this tax preparer? What are the rules as it relates to, per se, blowing in a tax preparer that you got a return that you know is blatantly wrong? Do we have a duty to do that? And can we be held responsible for not turning in a preparer that we see substantially over and over bad tax returns?
And you know what, Al, that's a great question, and I get that just like you do a lot of times as we're doing different types of seminars and discussions with tax professionals. And the bottom line is that there is a form, there's a complaint form that we can file with the government when we see these outlandish tax returns that are just complete incompetence or disrespect or recklessness in the preparation of the tax return. And that form that we can file as a practitioner is a form 14157. It's a 14157. That form is a complaint to be filed against a tax return preparer. When it is filed, it is giving the information of the preparer and what they have done inaccurately. It's not disclosing information about our new client and what their tax return actually showed. So it's a complaint against the preparer. Now, we aren't required to file that, but certainly it is an avenue for us to make sure the government is aware that there's a practitioner out there that is completely going against what the rules and regulations allow us to do.
And I take this, and so you understand as the practitioner community, that we're not, per se blowing in every wrong, line entry or something that we see wrong from another preparer. This is really when you see egregious stuff like somebody abusing taxpayers, taking refunds, or taking expenses that are substantially egregious or wrong on the tax returns. Again, we don't advocate, releasing that information. And again, it is not required, but there is an avenue for you guys as practitioners out there to make sure we get rid of those that are the bad apples that give us the bad names.
Absolutely. And sometimes the new client will ask you, is there a way that they could file a complaint with the government? And that is the same form. That would allow them to be able to do that same thing. Absolutely. So now let's talk about when we've prepared a tax return. So we are the practitioner that prepared the return. At the time we prepared it, we could honestly state and sign that return under penalties of perjury that we believed all the information to be accurate, true, complete, and correct. But now, after the fact, something has come to light, and we've now discovered that there was a mistake that was on that return. Let me give you an example. The client has been your client for the last 3 years, and they're a divorced taxpayer. Their son has lived with them for years, ever since the divorce took place. You have filed the taxpayer as head of household and claimed that son on the tax return since the divorce. Per the divorce decree, everything gives her that right. Now all of a sudden the taxpayer has come to you in the grocery store. Let's say you run into her at the grocery store, and you just happen to ask how the son's doing and what's he up to, and it comes out during that conversation that the son actually moved out to live with the dad a year and a half ago. Now we have a problem. And so, we address with the client, okay, well, last year's tax return, last year when you were doing the organizer, as we were preparing the tax return, the discussion was had that the son was still living with you. And now it's been discovered that that was actually incorrect. The information provided by the client at the time of the return preparation was not accurate. Bottom line is that because now is when we became aware of the wrong information, we could not have a penalty or a sanction on that prior return. But it comes down to, can we prove when we became aware of that information? And that's where the documentation becomes so critical. We need to be going back to the office. We need to be documenting in the file when that conversation took place, so that a year from now or 2 years from now, we have that documentation proving when we became aware of that. We absolutely need to tell the client we should be going back and filing an amended return. It's going to create a balance due. Penalties and interest needs to be taken care of as quickly as possible. If the client says, yep, that's fine, I'll contact your office and schedule an appointment, what I would always suggest that we should be doing is circling back in and creating a paper trail. We should be sending an email to that client so we've got documentation that something was sent out that tells them it was great to see you at the grocery store. It's fantastic to have a chance to catch up with you. Please don't forget to call our office as soon as possible to schedule a time to come in to get that 2012 tax return amended. Remember, we were going to have to take off your son since he wasn't actually living in your household. It will create a change that will create a tax liability. Penalties and interest accrue, so you contacting us and us getting this taken care of as soon as possible will limit the amount of penalties and interest. Now, what have you done? You created a paper trail that's documenting when you became aware of what happened and what you're telling the client needs to happen. You are also assisting that client. That client has now gotten that reminder email now that they're back at work and able to focus on these important tasks to say, you know what, that's right. I ran into Sue. I need to make that phone call. I need to get in there. I need to get that taken care of. So it is a win-win for everyone so that we're not going to run into problems later on down the road for that client.
All right, we're going to go into one of the big questions we always get here. And it seems like almost a common sense answer, but the reality is we still get questions on it all the time. Right. And that is, how do we obtain payment? How do we as practitioners get paid? Can we, as practitioners, receive in some way, shape, or form a payment through the client's federal tax refund? And Sue, what do you think about that?
Well, again, Al, this is one of those areas that it's just so clear-cut, black and white, that we really should not ever have an issue with this. But over and over and over again, we see from OPR that there are practitioners being sanctioned left and right for doing this incorrectly. Circular 230, Section 10.31, very specifically tells us that we as practitioners cannot in any way, shape, or form endorse or otherwise negotiate any kind of a check that was issued to the government issued to the client by the government. So they even issued out recently a proposed regulation, and that proposed regulation goes on to more detail to say that that includes directing or accepting payment by any means, electronic or otherwise, into any account that is controlled by us as practitioners or a firm, a company that we are related to in any way, shape, or form. So what it is telling us is that under absolutely no circumstance ever should we be cashing our clients' refunds checks, taking our clients' refund checks in any shape or form. And that includes a partial amount of that refund check being taken. And Al and I were just speaking about this morning. The Form 8888 has caused a lot of problems with this over the last couple of years. Remember, the Form 8888 is the form that allows us to have a refund check for our client split and deposited into multiple bank accounts. And according to OPR, one of the problems that they're seeing is that these practitioners will take and have their fees, a reasonable fee, not an unreasonable, not something obnoxious, a reasonable fee. They'll have it be direct deposited into their bank account, the company's bank account, by using the Form 8888, and then the remaining portion of the client's refund is deposited in the client's checking or savings account. You know what? In theory, it almost sounds like a great way to be able to make sure we're getting paid, but the reality is the law says we are not allowed to do that. Not at all.
Sue, how many times do we hear practitioners say, well, then if we can't do it that way, how does the big companies like the major national preparers that we see out there, how do they get away with doing it? How do they do the RALs, refund anticipation loans? How do they do it?
And you know, Al, that's also a great question that we do hear a lot.
Seems almost unfair, doesn't it?
Right. And then, you know, the RALs, or the refund anticipation loans, are done and set up differently. Are they under scrutiny by the government? Are they being looked at? Absolutely. They have been for years. There's been significant concern that some of these rapid refund programs, or RALs, that are being offered have extreme fees that are being paid out to the companies rather than the refunds being given to the taxpayers, which is obviously where that money is intended for. But the bottom line is they are following the rules. They are adhering to the law. Let me explain to those of you that don't understand how a RAL actually works. When I come into your office as a tax preparer and you offer a RAL program, what you're doing is you're determining that I'm entitled to a refund of, let's say, $3,000. So that refund is something that we know at that point in time. Once we know the amount of the refund, I then apply for a loan from a financial institution that your firm works with. So they actually have me do an application for a loan, and that financial institution either approves or denies that loan. When they approve that loan, they tell me right up front, we're going to charge you $600 in fees for that loan, and so they then cut me a check within a couple of days for $2,400. Okay? What happens on the other end is then that financial institution is setting up a bank account for me in my name. It is my bank account set up at that financial institution. I've then signed an authority, an actual authorization to them that says once my refund of $3,000 is deposited into my bank account at your financial institution, I am authorizing you, Mr. Financial Institution, to take out your $600 in fees and to pay off my loan of $2,400 that you gave to me. So the way a rapid refund or a refund anticipation loan works is that I am ultimately getting the money into a bank account in my name. I've just pre-authorized those funds to then be dispersed back out to pay all of those fees.
So really it's a way for these other companies to work around, but the reality is if we're not a financial institution or recognized by the IRS as financial institution, we can't go and doing that. And under Circular 230, there's no way in any way, shape, or form we should be doing that.
Absolutely not. I would tell every practitioner, stay away from this. Do not get involved in this type of stuff, and don't ever try to do it with a Form 8888. I was just reading online about 2 weeks ago that there was a practitioner down in the Texas area that was doing this type of a circumstance, and he had sanctions brought up against him, and he is now dealing with issues with the government because of this type of a circumstance where he had the Form 8888 dispersing his fees into his account and the difference into the client, and he did it on several hundred clients' tax returns, and the government is going after him for every single one of those individually.
Okay, let's move on here. We're going to be talking about fees and what the definition of unconscionable is, and fees related to preparing returns, and contingency type fees. This is a kind of a big question we got. Sue, go ahead.
Right. Right. Well, you know, when we're talking about fees that can be charged by us as practitioners, the government tells us in Section 10.27 of the Circular 230 that our fees cannot be unconscionable. Okay, that means they can't be unreasonable. How do we actually determine what a reasonable fee is? Then kind of becomes that question, because we don't want to overstep our boundaries and charge fees that are above what we should be. And I would tell every practitioner, you should watch what the market is charging. Do some competitive shopping. Find out what other practitioners in your area are charging for similar type of returns. Now, it doesn't say you always have to be the cheapest guy in town, but we have to make sure our fees, if they are going to be at the higher end, are certainly still falling within a norm, okay? So they can't be unreasonable. There are a lot of different organizations out there like IAAM and different types of practitioner organizations that do studies where they will determine in our market areas what the going rate is for different types of tax preparation. And again, I was just reading a study the other day where they're anticipating that our fees as practitioners will be going up this year, that is what the basic studies are showing, is that those fees are expected to rise. So utilize those studies. Take a look at what they're showing are reasonable fees in your area. Not only is it going to protect you for the Circular 230 issues, but it obviously is also going to give you a great starting point of maybe this needs to be a discussion in your office of we need to be raising our fees. Maybe we are under market in our area, and that's something that we could take a look at, you know, as obviously a whole separate issue. Make sure you're keeping those studies and the different material that you utilize to determine your fees. Keep those types of things so that you've got them in your file, so that if there ever is a question, you've got that documentation to refer back to. Let's also talk about contingency fees. You know, it tells us that we can't charge a contingency fee unless we're talking about a circumstance where we are dealing with something that is either IRS audits or representation, penalty abatements, those types of circumstances. So in other words, what they're telling us is we can't turn around and charge a contingency for a tax return that we've prepared. Because let's use an example. Let's say that the client comes through the door and a practitioner, none of us, because this would obviously be unscrupulous, but let's say a practitioner maneuvers the tax return so that the refund is going to be $8,400. And that practitioner says, if I can get you the $8,400 refund from the government, if they'll actually send it to us, then I get 20% of it. Okay? That's a time that we cannot charge a contingency. Okay? That's a circumstance where we can't do that. And the government's reasoning behind that is because if I'm going to get a percentage of my client's refund, then I'm going to be more apt to always want that refund to be as large as I can possibly push it to be, and that could lend us to preparing inaccurate tax returns. So that's the difference. Now, if we are preparing a penalty abatement letter for our client, and we tell the client, look, I'm going to attempt to get this penalty abated that you've already paid the government. So if I'm successful in getting this penalty abated, then you agree to pay me a contingency fee of 10%. In that circumstance, we are going to get a percentage of a refund that the client ultimately gets from the government, but it's a refund of penalties that have already been paid, and that is completely allowable because all we're doing there is we're securing the client's interest and saying, if I can't successfully represent you and get this money back, then you don't have to pay me that fee. Okay?
So I'm going to jump into the next section, which is client records, and I'm going to talk about this a little bit. A lot of times practitioners come to us and they say, you know, I'm not quite sure, you know, the standard questions we get are how long do we keep our records? But one of the main questions we get a lot of times is, in an ethical consideration, is what do I have to give back to this client? I may have a client that I'm done with, or I may have a client that wants, you know, sometimes we get clients that want every piece of document or every piece of work that we did, our work papers and everything else. So there's a lot of questions about that coming into it. The Circular 230 on 10.28 is very specific, and I'm going to go into some good practices and best practices. It very specifically states that any type of return documentation, original documentation that your client provides to you must be returned to them if and or upon request, and that any documentation that they provide that is needed for them to actually file a tax return, okay, that's another category, also must be returned to that client. So we can't, as practitioners, unscrupulously withhold that information because we're holding hostage because they owe us money or are going to pay us money. What comes into it is the truth of we have a right for our work papers and our work processes to be protected, and there's nothing wrong with that. We also have the right to keep copies of the originals of our clients to back ourselves up and to document how we determined tax returns or anything to that effect. Sue, how about fax documents? What do you think about that? We have that a lot of questions asked us on fax documents.
Right, and the answer to that, Al, is that any document that the client has provided to us is considered a document that they have a right to get back, even if it's come into us via fax or maybe through an email. If the client is now asking for those documents back and they need those documents to accurately prepare a tax return, then we are required to give those documents back regardless of whether or not they have an outstanding balance due to us.
What if a client comes to you, Sue, and says, well, I want all your work papers to determine what you did to prepare my tax return? How do we handle that?
Well, and that's another good question, and it really depends on what our office practice is. We are not required to turn over any type of work papers or our work product if the client has not paid us for those services. But once they've paid us for those services, they really are entitled to at least an understanding of what we've done. If your office has a practice to not turn over different types of documentation, then that's certainly something that you should make sure the client is aware of going into the engagement. But if it is information that they need to accurately prepare a tax return going into the future, then you probably, as a best practice, should be handing that information over. And that could include something like maybe a depreciation schedule from this year's tax return that you created. They've paid you for everything, and now they've decided to move on to a different accounting firm and are asking for that depreciation schedule. If they've paid it, we really should be handing that over because they do need it to accurately prepare future returns.
And Sue, and to the practitioner community out there, one of the practices that we do that is a best practice in our office is when we turn over original documents back to a client, we make sure to have a custody transfer document. That means very specifically it lists every document that I'm turning back to them, and we make the client sign and date for those original documents to be received back to them. So I have in my record an acknowledgement form in the file that I met the criteria under Circular 10.28 and provided back to my client all their original documents.
Yeah.
How many times have we had practitioners say, I gave them back that document, I gave them back all the original returns, but because I pursued them in collections of my bill and they went to OPR and filed a complaint, and I don't have any way to prove I gave them back my documents.
Right. And you know what, Al, that's so true. And so many times when we talk with practitioners about these different OPR complaints that are filed, it comes down to what we as the practitioner can prove did or didn't happen. So using these transfer statements is actually a way for us to be able to sit down with the client and say, okay, so I'm giving you back everything you gave me, and by signing this, you're agreeing that I've given you back everything. Now we've got that in the file to be able to prove that later on if it ever does become an issue, because unfortunately, anyone can file a complaint against us as the practitioner community, so we need to know how to arm ourselves.
Okay, we do have a question that came in here. It said, what if a non-paid preparer doing child's return and having refunds deposited to the parents or preparer's bank account, even if a child and an adult?
So if a non-paid preparer is wanting to have a refund of a child's tax return put into a parent's bank account? Is the question, I think, is what I'm actually reading here. If we have a child who is a minor, then the parents are the ones that are legally responsible, and a refund could be deposited into their bank account.
Usually when there are accounts of minors, they are called custodial accounts, meaning both the parent and the child will be listed on there, because as a child under the age of 18 are usually not allowed to have accounts by themselves. So I want to make sure we're clarifying that. What if a non-paid preparer doing a child's return and having returns deposited to parents or preparer's bank account, even if the child is an adult?
Okay. If a child is an adult and they are no longer a minor, then that refund should be deposited into a bank account that adult child's name is on. It should not be going into a bank account of a third party, and that really is what you would be doing by depositing it into the parent's account. So that would be something I would tell you should not be happening.
And we did have another preparer out there, put another chat item out there. He made a comment on here. It says, beware about discussing fees with competitors and antitrust implications. Our take on that is there are some antitrust rules and what they call Stark rules. We're not going to go into that. It's a very complex subject. But when you have organizations such as the IAAM or some of the other organizations that you all may be involved in, I highly recommend and encourage you guys review the market studies that they provide. Be a part of these organizations, both on the state and national wide, that can kind of give you an idea of what you're doing as far as what the market can bear in that circumstance. And I think it relates to what we talked about earlier in the mix. There's nothing wrong with being competitive in the market versus maneuvering or working with a bunch of local CPAs to price fix your fees or to make them higher than they should be. The IRS is smart. They do watch that kind of stuff, but that's a good statement that we don't want to be in a position where we're price fixing fees, which would be a no-no.
Absolutely. I couldn't agree with you more, Al.
We're going to move on.
Hey,
okay.
Alan,
yeah.
Susan, I just wanted to bring up a question in regards to client records, and it's a question that we often field here at the association office. We will have a practitioner who's gained a new client, and in the process of trying to get the records from the previous practitioner for the new client, they run into difficulty because the practitioner either hasn't been paid by the client and doesn't want to turn the records over, or there's some type of a dispute involved in the transition of clients. I'd be interested in comments as to from both the practitioner receiving the client and the practitioner losing the client as to what they should do in situations like that.
Absolutely, absolutely. When we have a circumstance where the client, the practitioner is having a tough time getting records from a prior practitioner, there sometimes can be a couple things that are happening. As a practitioner, if I have a new accounting firm contact me and say, hey, John Smith has decided to go with us and he's asked us to get copies of his tax returns from the last couple of years from you guys, I can't just turn over my client's information to a third party without that client's specific consent to do so. Even though they may not be my client anymore, I still have all the privacy rules and disclosure rules that I have to adhere to. So sometimes the problem can be as simple as I need to get a hold of the client and say, this other accounting firm has contacted me. Do you want me to send this information over? When they say yes, then I need to get them a disclosure form, which is something we're not talking about today in depth, but there is actually a consent to disclose form that the government has. Revenue Procedure 2013-15 outlines exactly what that disclosure needs to state, and you have to have that client sign that document before you turn anything over to that new accounting firm. There are specific language that has to be in that document, so be very careful that you're adhering to all of those terms. Sending an email to you, the client sending an email to you saying, hey, I want you to send the stuff over to AB accounting firm, is not good enough. There has to be specific language. Now, obviously a way to work around that to try to save you some of the paperwork would be to just take that tax return information and send it directly to the former client, providing them with a duplicate copy of what you've given them in the past, and then they can forward it over to the accounting firm. So sometimes that's really the crux of the problem. Other times, John, I think what you were talking about as another potential problem is that there's now this issue going back and forth about fees and things not being paid, and so the accounting firm is trying to hold those documents, waiting to get payment, and they try to almost hold them hostage. And that is exactly this section of the Circular 230 that we were really talking about. So I'm glad you brought it up. This is the section where Circular 230 10.28 specifically says that upon the client's request, we have to promptly return any and all records of the client, so anything they gave us that is necessary for the client to comply with their federal obligations, or to, if we summarize that, to accurately prepare that tax return. So anything the client has given our accounting firm, we have to turn back over to them if they requested and they needed to prepare that tax return. And like Alan said, we can keep copies of everything, so if later on we try to take them to collections or try to pursue the fees, we have documentation to prove what we had. Maybe 2 months later they actually come in and pay for the tax return. Now we've got the copies of the records that we would normally need in a file for a return that's been submitted. But we are not allowed to hold those records hostage if they need them to be able to file that tax return. We do have to turn them back over. Our work papers, like Al said, we don't have to turn over. We can hold anything that is our work product, but their documents have to be given back to them.
Okay, we're going to jump to due diligence. John, did that answer your question?
Yes, it did. Thank you.
You're welcome.
Awesome.
Okay. On to slide 17.
Okay, due diligence. Due diligence is, again, one of those areas that, according to the Office of Professional Responsibility, a lot of practitioners start to run afoul and into trouble. And so when we talk about due diligence, what we really come down to, and this is in the Circular 230, it's section 10.22, but what it really boils down to is that we have to ask enough questions to get to the right answer. Our client is paying us as specialists to prepare their tax returns, and this is what they expect of us, and this is what is expected of us from the government and the Office of Professional Responsibilities. So we have to exercise due diligence by asking the questions. And a lot of times I'll use the analysis that we need to do our sniff test. As we're going through and we are handling the tax return and we are working through and asking questions, when something doesn't start to make sense, it starts to just not smell right, we should be asking additional questions so that we can clarify that. Now, according to OPR, one of the things that we have to make sure we're doing is that we're actually documenting these conversations, because otherwise, later on down the road, if this client becomes unhappy with us, how do we prove what conversations actually took place if we don't have documentation to really be able to show that? A common question that comes up is, can I trust what the client is telling me? Am I allowed to take their statements and information, or do I have to do more? And I always have to remind practitioners, it is not our job to audit a tax return. It is our job to ask enough questions to get an accurate return, but we absolutely can rely on our clients' statements and other type of documentation that they give us, as long as it passed that sniff test.
So basically, Susan, what you're saying is if we do this sniff test and we feel or have a feeling that something's not right, something is inconsistent, incomplete, doesn't make sense to us, then we can, or we are required at that point in time to ask more questions to clarify it. And would you recommend at that point to document that inconsistent feeling and what you did to clarify that inconsistency?
That is exactly what I'm saying, Al. You know, if you have a client and you have an organizer that you use, and in your organizer you ask the client if they have any type of foreign bank accounts, and they tell you no, but then this client has also mailed the organizer to you, and within it their check for payment for this tax return. And guess what? That check is drawn off of a foreign bank account. We got a problem, right? There's where my sniff test just said, whoop, we've got a major smelly item going on here. How can they tell me in their organizer that they don't have a foreign bank account, yet they're paying me out of a foreign bank account that's in their name? We'd have to ask more questions to get some answers. Now, the answer could be as simple as the client says, as of the end of 2013, I did not have any foreign bank accounts, but I just in March of 2014 moved to Canada, and now I've set up a bank account over there, and so next year my answer will be yes. Now we've got that clarification, and absolutely we need to document those things in the file. If you're using an organizer or something, a tax planner or an interview technique, whatever you use, make sure you are documenting not only the questions that are causing concern for you that you feel you need to ask, but what the client gives as an answer. Because let's think about it one step further. This is going to become an issue when a client becomes disgruntled. And let's say that 2 years from now, this client's tax return is audited. And when that client's tax return is audited, the client tells the IRS personnel that my accountant was fully aware of that. I told them all about that. I don't know why it didn't get properly answered on the tax return. If you don't have the questions and the answers in your file to be able to document and prove that conversation, it is nothing more than a he said, she said. You're saying one story, they're saying another story, and the IRS OPR is going to have to determine who they are going to believe in that circumstance. And when the client says, hey, look, I even paid him with a foreign check, obviously he must have known I had that foreign bank account, then that's going to be something that is going to go against us and could cause us problems. If we've got the documentation in our file, the notes in our file, then that's going to be able to help us to be able to prove that at the other end.
So basically what we say in our office is, look, if it's not in the notes, it never happened.
Right.
And we make sure that our staff will go back and redo those notes to meet it. And we go as far on our notes as a best practice for our office to put the date, time that we spoke with this person.
Right.
So it has a very chronological type history on it that we can go back a year or 2 years and say, we spoke with you at 4:30 p.m. on Tuesday night.
Right. And you know what? It takes a little bit of extra time. And during tax season, we have a business too. We understand that you got to keep the money coming through the doors, and taking all this extra time sometimes can be very burdensome to the tax practitioner. But it's also going to save you a lot of headache on the other end if there ever becomes a question or an issue. And think about it this way. That client, you can go back through those notes and you can pick up summary of information that you're going to need to remember for the next tax season, and that's something that's also a service to your client.
Absolutely, and I can't even give the other side of it. From a business perspective, it's also good against defenses if you have to collect on fees, to say, we spoke about this, we talked about this, I did this for you, I did that for you. We had 5 conferences at this time and this day. So it really just adds to the validity of the work that we're doing as practitioners, and really gives us a really good defense against any type of preparer penalties. The basic rule, you don't meet the sniff test, we can't turn a blind eye. That's the basis here.
Yeah, absolutely. And it's funny because in our office, everybody knows that things have to be well documented. Alan comes from a very legal background, and when he worked for the government, he was a revenue officer, which they are legally minded. They have to follow certain legal procedures, and so documentation is so critical as a background for him that our staff knows that the comment that is always going to come out of his mouth is that if it's not documented, it didn't happen, and go do it again. And when you have new staff that has to go back and redo work a time or two because they didn't document it properly the first time, they learn really quickly to make sure that they are documenting things properly in the files.
Okay, we had 2 questions coming in. One, can we have a short discussion regarding divorce tax clients? We'll try to touch on that real quick. We'll try to have some discussion about that at the end.
Yep.
We do want to make sure we touch on all the Circular 230 issues. The next question, it says, if you think the client is not telling you the truth, do you call them on it, and do you drop them as a client? That's a great question.
And you know, this is a question that comes up quite a bit, you know, when something's just not making sense. And here's the way I typically handle something like that. I'll tell the client, you know, let me ask you some more questions, because I guess I'm not understanding what you're telling me. It's not making sense to me, and if it doesn't make sense to me now when I've spent this much time with you, it's not going to make sense if some other IRS person was ever reviewing this tax return. So let's go back, let's circle back, let's rediscuss this specific issue, and then I will circle in and ask very specific questions and try to really get down to the bottom of that circumstance. Let's talk about EIC for a second. That's always a great example when we start to talk about these types of issues. If the client comes through the door and he tells you that he's got a baby girl that lives with him, it's just him and the baby girl, she's 2 years old, they live in the household together alone, he works 40 hours a week and he works second shift, okay? In that kind of a circumstance, I'm going to expect to see or have a discussion with him that he's got some daycare expenses, because if he's a single parent and the baby's only 2, well, then there's got to be somebody who's taking care of that child while he's at work every day. If there's no daycare expenses anywhere in there, his organizer says that he has no type of daycare expenses, then I'm going to ask the follow-up question. And if my question is going to be, who watches the baby while you're working? Because, you know, there is a credit if you've got daycare expenses. So you're always going to spin it to the benefit of the taxpayer. Hey, I'm trying to make sure we have an accurate return for you that's going to pay the least amount of tax. So let me ask you these extra questions. If his answer is, my mom lives 2 miles from me and she loves the baby and she is so wonderful, she babysits the baby for me every single day, fantastic. That makes sense to me. I'm going to document it in the file that this is the discussion we had, and I'm going to move on. If his answer to me is, well, you know, I have some friends here and there, various people, you know, I usually just call around and see who's available to watch the baby, that doesn't pass my sniff test. That doesn't make sense to me. Maybe it's as a mother or as a parent, but I know I'm not going to pass my 2-year-old around to various people and always wait to the last second to try to figure out who's going to watch my kid the next day. So at that point in time, my comment to that client would be, you know, when we're talking about a tax return such as yours, the IRS does put additional scrutiny on head of household tax returns, especially when they are filed by a mail. So let's do this. Let's get some additional documentation that we're going to put in the file to prove that you qualify for everything on the tax return this year. That way we'll have it going forward into the future. And that way, if this return is ever pulled for review by the government, we can protect you from any type of penalties and myself from any type of penalties, because we've got everything well documented that you were actually entitled to this deduction.
And Sue, that's an excellent way to not only back us up as our due diligence as preparers, but part of that second question is, look, when do you drop them as a client?
Right.
And the reality is we as practitioners should never be putting ourselves, our livelihoods, our licenses, our reputations, our business reputations on the line for somebody that doesn't care to follow the rules.
Right. Absolutely.
Our job is to lead them, to properly educate them, and to make them follow the rules of law just like everybody else has to. And if they refuse to do that, or in Sue's example, they keep giving us wishy-washy answers, there is nothing wrong with saying, you know what, I'm not comfortable preparing this return, and you're going to have to seek it elsewhere. There's nothing wrong with doing that, and I would encourage the practitioner community out there to do that in those circumstances where you're not getting straight answers.
Right.
You don't know how that stuff can come back and bite you in the rear end down the road.
Right, absolutely. And, you know, if this gentleman is in a circumstance where he's really entitled to these deductions, I'm going to give him some ideas of different documentation I would need for the file to prove that the child was living with him, that he was providing the value and the support and the care for this child, and those are going to be documented in my file. If he doesn't want to provide those, then it's time for him to go, just like Al said. You know, I tell my clients right up front, I'm a licensed representative. That means that my license is valuable to me. Without it, I can't do what I do. And I explain to them, I will walk the line of the law with you all day long, but I will not cross it. So if you want me to investigate a gray area, or you want me to tax plan, or you want me to zealously represent you legally, I will be right there standing in the gap doing it for you. But don't ask me to cross the line. And that's when we have a client who wants us to cross the line, that's when we have to know it's time to let them go.
All right, we're going to speed up a little bit here. We're going to go into some supervision real quick, and this is under 10.36 of the Circular 30. That's 10.36, and that deals with supervision.
Right. And when we're talking about supervision, we're really talking about the tax firm and the company itself. And what we know is that as a firm, we have to be able to show that we've taken reasonable steps to ensure that the procedures under Circular 230 are being adhered to within that company, and that they're being complied, or the compliance is happening. So when we're dealing with those types of issues, we have to make sure there's policies in place that actually are going to tell the employees that this is what they should be doing. Not only do we have policies that need to be in place, but you need to have a management staff that actually adheres to those, monitors them, and promotes them within the office. In other words, what I'm saying is make sure that you never have a manager that's telling an employee to do something that is opposite of what the Circular 230 says they should be doing, or what your policy is written in the office. Make sure everything is cohesive and working together. Educating employees within an office is the #1 way that a firm can prove to the government that they have proper supervision, making sure that they talk about policies, follow policies, having ethics webinars like this for all of our staff, licensed or not, whether there's a requirement for them under their continuing ed to get 2 hours of ethics or not. Being able to prove these types of education opportunities are being afforded to them is going to be able to prove that we are adhering to that proper supervision.
Can't agree with you more, Sue. Jumping into best practices, 10.33 of the Circular 230. Basically what this says, and we're going to stress this, and we've kind of been stressing it all along, is that when you're dealing with your clients, you need to be making sure you're communicating very clearly the terms of your engagement and clearly putting that in. How many times, Sue, do we talk to practitioners where there's only a very small amount of practitioners that actually use a full-blown engagement letter that clearly defines what they're going to do? And this includes return preparing engagement-type letters. And it can be very critical for us in that manner to very clearly say what years we're going to prepare and or what the scope of the preparation is going to be.
Right. And, you know, an engagement letter is also the perfect place for us to discuss our fee structure so that there's no surprise at the other end, and for us to have a discussion with the client that they need to be candid and forthcoming with information. That's a perfect place for us to have that dialogue with our clients so we can very clearly determine whether or not they are clearly giving us all of the information that we need.
Very good point, sir. Very good point. We want to also make sure that we're advising our clients of the consequences of the failures along the way. We're communicating clearly the terms to them if they don't file timely, or if they don't provide us the proper information, or in the engagement, if they're not candid with us and are withholding information to us. It's a perfect opportunity for us to exert our privileged communications under 7525 and explain to them, hey, this privilege is there for your protection so you and I can talk freely without your concern of this information having to be disclosed to the government, and your opportunity to not only get into their head and find all the cobwebs, but also to educate them and to direct them in the correct way. Meet them to compliance. Sue?
And what I find a lot of times is as I talk to the client about what potentially could happen, what kind of penalties and things that could come about if there were to be a problem with that tax return, it gives me an opportunity to really explain to them why it's so important for them to provide that information up front, and why there's going to be times that I'm going to ask them lots of questions, or even ask them to get me some documentation, because I want to protect them from being able to be subject to any of those penalties.
Okay, we're going to move on. Competency. Is competency important?
You know,
does the IRS even define competency?
You know, it's amazing, because competency is one of those areas within the Circular 230 that Karen Hawkins, who is the director of OPR, refers to as a sleeper provision. In other words, what she's saying is it kind of lays in wait, and it waits for those circumstances where we have tax preparers that are taking a reckless disregard, or they are showing gross incompetence, and it gives the government the ability to step in with teeth and go after those practitioners, to sanction them, to disbar them, to do whatever's necessary to get them out of this professional community.
This really boils down to gross incompetence. And the key is, if we can turn around and educate our clients, educate our staff, and make sure that our staff is well-versed in the rules, and that this is even for return preparers, having CPE, even if you're not a licensed person, is something that you can show that your firm is doing to make sure that you're keeping the competency up within your firm. And that's critical. It doesn't matter if you're licensed or not. This provision can come after you as a return preparer without a license if you don't keep up with proper legislation, or you have no CPE that you do over your career.
Right. And, you know, when we talk about gross incompetence, we're talking about that person who has no business preparing that tax return. And that we have to know our limitations, you know, just like a lot of times we tell our clients, know your limitations. If you're not a bookkeeper and you're a bricklayer, then go lay bricks and hire me to do your books. We have to know our limitations. If our specialty is not dealing with estate-type taxes or corporate taxes, then know where our limitations lie so we don't run into those problems.
Okay, we're going to jump into the other side real quick here, and that is what happens to OPR? What happens to referrals? How do they get there, and what do we do? What can we be held accountable for with the Office of Professional Responsibility?
You know, I think it's so important for us as practitioners to at least have a general understanding of how the Office of Professional Responsibility actually works, so that, you know, with that knowledge, we know how to better arm ourselves. I think the most important thing that you've heard Al and I stress this entire time frame is that you have to be well documented to back things up. So how do things actually get into OPR? How do they get complaints? Well, they can either come from the IRS personnel when they see somebody that they believe is doing something that is a competency issue, or delaying, or, you know, gross incompetence, whatever it is, they can make that referral in. And then clients, taxpayers can make complaints against us as practitioners. So those are typically where the two referrals are going to come from. Okay, what types of issues is OPR going to take a look at? They're going to look at circumstances where a practitioner is being proposed that the practitioner is not following competency and compliance with the preparation of our client's tax returns. It can also be a circumstance where the practitioner is not timely handling their financial matters with the government. They're not timely filing their own tax returns or paying their employment tax returns. And then lastly, it can be, again, complaints against them from the IRS personnel saying that they were hostile or they were uncooperative or any of those types of circumstances. So the disciplinary process itself, how it works, as the complaint comes in, OPR, or the Office of Professional Responsibility, and the Return Preparer Program actually within them, they investigate the complaint. So they will do a full investigation. Once they've finished their investigation is when they notify the practitioner that this is even going on. So you don't know until after they've already done their investigation that something's even happening, and then they give you an opportunity to respond. You always should make sure that you are responding to these types of circumstances. Once your response comes back in, a panel is going to review that, and then they are going to propose action if it is merited. If they determine that there's nothing that should happen, your response explains it away, or your response gives them the explanation that they need, then they can determine to do nothing. If things aren't able to be handled at the panel level, then it is going to go before an administrative law judge, and it's going to be litigated. Those decisions can be appealed, okay? So what can actually happen becomes the next question. What type of sanctions are out there depend on the type of case. There can be a reprimand. It's just a, hey, don't do that again type of circumstance. There can be a censure, which means that it's going to actually become public, that there is a punishment, a warning per se that is going to go out there. There can be a suspension from practicing before the IRS. And remember how we defined practicing earlier. Practicing means tax preparation all the way through representation. So if they suspend a practitioner for a year or up to 5 years is what they can do, that means you literally are unable to prepare tax returns. And a firm, another tax professional, is not allowed to hire a tax preparer to work within their office under any facet if they are currently under suspension, which means you can't even go work for somebody else during that time frame. Disbarment means that they're going to literally take you out of it. You are not allowed to continue to represent at all or practice at all going into the future. Now, after 5 years, you can go back and show that you should be given a second chance, and they can look at that. Monetary penalties is another thing. They can actually, if they take us to at a criminal level, there can be, jail time and everything else,
restitution.
and there can be restitution. But monetary penalties is where OPR can say, we're going to penalize you for doing these things wrong. Like a circumstance where you withhold client records and you refuse to give them back. That's a $500 penalty per circumstance when something like that happens. That would be the monetary thing. Now, if a firm is charged with any type of wrongdoing at OPR level, monetary is the only thing that they really can do to a firm itself. Okay, so let's talk about the disclosure, because that is a concern a lot of times for practitioners. They've done something wrong. Maybe they didn't timely file some of their employment tax returns. Maybe they fell behind, and so they say, I can't let anybody find out. It'll ruin me in my community. OPR can disclose under public disclosure for sanctions for any decision that was issued after September 26th of 2007, or if we as a practitioner actually consents to the sanction, so we agree that that's something that can happen, or if there's an expedited proceeding that's actually taking place, where there's someone who's actually at a level where they have lost their license or there's some sort of a criminal conviction. All of that will become public record as well. So public disclosure is absolutely allowed. Let's talk for a second about us as practitioners when we are not in the circumstance where we are handling things timely on our own business, what we are supposed to be doing. So that the OPR is allowed to suspend us for not handling our financial affairs properly when it comes to our tax matters. Generally, if we're talking about our individual tax returns, the penalties are going to be something like a suspension or a monetary penalty. If we're talking about employment tax returns, they obviously will come down a lot harder, just like they do under normal circumstances. Expedited suspension procedures means that the government is allowed to fast track this. They're allowed to come in and come down hard on us very quickly when we have circumstances where we have not filed 4 out of our last 5 personal tax returns, or if we have not been filing and paying 5 out of 7 of our quarterly returns or monthly returns. So if we're talking about, again, business returns that are required to be filed on a more repetitive basis. So those are things. Now, when we start to talk about what could actually mitigate or aggravate that entire circumstance, if we have a circumstance where we realize that something has fallen behind, and I had a good friend of mine a couple years ago in this circumstance. His wife was handling the books at his accounting firm, She was running into some medical issues and some depression, and she had just stopped making all of their tax deposits, had just decided that she couldn't handle doing that stuff anymore, and it was middle of tax season, so she knew he was busy, and she just never even told him that she had stopped doing these things. After tax season, while he was going through and reviewing books and things for the company, he realized that this had happened. He immediately, that same day, made all the past due deposits. He did everything that same day to resolve that issue. He came to me afterwards as a friend and said, I don't know what I'm going to do. If I lose my license, I'm sunk. How am I going to, I employ 12 people. How am I going to explain this to my employees? And the bottom line is that he self-corrected that entire issue before he was ever contacted by the IRS. He had an explanation. He had reasonable cause. He had documented records showing that his wife was having medical issues. So those are things, obviously, that would all mitigate the circumstance. On the opposite side, aggravating it, we certainly don't want a circumstance where we just try to avoid or cause more problems or aggravate that. We want to make sure that we are doing everything we can to mitigate any kind of those circumstances. Alan, that's everything I wanted to talk about as far as how OPR handles different types of penalties or sanctions or complaints. If you're ready, let's move on to some of the questions and answers or questions that we've gotten from the audience.
Okay, we can do that. One of the questions was, how does it deal with divorce? How do we do that as far as that goes? Can we have a short discussion regarding maybe some ethical considerations regarding divorce and taxes?
It's always a great question because a lot of times when we start to deal with a divorce circumstance, we now have two clients that have always loved us and they both want to stay with us. They want to continue to have us prepare both of their individual tax returns now going forward. And when we have that type of a circumstance, if we as a practitioner can confidently say, I can continue to prepare both of your tax returns and I can zealously prepare both of them, zealously practice for you, then there's not a problem. We absolutely can do that. There are going to be some times, though, that there is too much friction or too much something between those two taxpayers, and we've got to make the call to say, you know what, I can't do that. It's going to be best for each one of you to move to a different firm or a different preparer or something like that.
We have a real live case that we just dealt with last month where that was the circumstance, where we had husband and wife come in, they were amicable, and they were going to do an offer and compromise. And then that divorce got real ugly, and they brought in their divorce attorneys, and they started to split ways. And the wife was advised by the attorney that an innocent spouse was something that could be done on her behalf related to the tax obligations of the husband. Well, we had both clients coming in at that point in time. We had to stop what we were doing. The wife came back to us and asked if we would do an innocent spouse for her while we were doing an offer for him. So there was some conflict at that point in time. We had to literally pull them in and advise them in writing and have what they call a conflict of interest waiver signed. And the Circular 230 under 10.29 very clearly shows that a conflict exists if the representation of one client will be directly adverse to another client, or there's significant risk that the representation of one or more clients will be materially limited by the practitioner's responsibility to another client. Well, I can't represent one client on an offer and then turn around and say to the wife, that she wasn't fully responsible for that tax and represent both persons at the same time competently because there are material issues that are limiting that circumstance.
Right, and my rule of thumb whenever these kind of circumstances come up is I always literally in my own mind split everything apart. And I say if I was just representing the ex-wife, what would my plan of action be? And then I come to the other side and I say if I was just representing the husband, what would my plan of action be? Now, if I'm going to represent both of them, do I have to alter those plans in any way, shape, or form? If the answer is yes, then I've got a potential conflict. Now, it doesn't mean I can't represent both of them. It just means that I have to make sure I brought it to both of their attention that I've got this potential conflict. And that is something that they both have to acknowledge, agree to, and then say, we still want you to continue to prepare our tax returns in that circumstance.
It must be in writing.
Absolutely.
That's what we do. It must be in writing because there is no law that a practitioner can be prohibited to represent each of those clients if they sign that waiver, and it is clearly disclosed to each side that there may be a possible conflict down the road.
Yep.
We always recommend that conflict of interest waiver be signed, whether or not you can foresee it or not. Make sure it's done.
Yep, and the minute that you realize that there's a potential for conflict is the minute that you should be getting that conflict of interest waiver signed before you move forward. Okay, so that is what you should be doing. The Circular 230 tells us that we have 30 days to get a conflict of interest waiver signed once we become aware that there is a potential for conflict. So remember, documenting in our file when we became aware of when that potential conflict could exist is critical, because then otherwise how do we prove the 30 days? The last thing that I want to say on that is that we also are required to retain that conflict statement for 36 months beyond the end of our engagement with that client. So if I keep that client on board with me for the next 5 years, I have to keep that statement for the next 8 years, because 5 years I'm representing, 36 months beyond that. So make sure you're retaining this in a safe place and there's no chance it's going to get shredded when you're getting rid of your old document.
With retention policies, which normally are 5 to 7 years.
Right.
Right, you have to be aware of that. And my final statement for this, for everybody, is that not only is this conflict waiver good for a malpractice type suit if somebody wants to be sued down the road, but the IRS OPR can also request a copy of that conflict waiver statement. So
Absolutely.
The IRS has a right to look into it to make sure you're following the Circular 230 rules as it relates to conflicts.
Absolutely. You know what, everybody, I think we've reached our time limit. I'm going to thank everybody for their participation and let John give you some final housekeeping points when it comes to your CPE. Thanks, everybody, for your participation.
Guys. Take care.
Well, thank you, Susan and Alan. I can tell you I've covered these for a number of years since they become mandatory, and I just want to tell the two of you this is probably the best ethics presentation that I've ever sat in on and listened to, and I'm not a practitioner. I think the information that you folks provided today to our members is invaluable, and I'm very hopeful that everyone will use this and help them to be more profitable during this upcoming tax season, which is exactly what our association is here to help them do. So again, thank you two very, very much for this excellent presentation. Before I close, just a quick reminder to everyone, you will be receiving an emailed certificate of attendance for this event. If you provided us with a PTIN number, we will report those credits to the Internal Revenue Service into your PTIN account. Now, if you're not sure whether or not you gave us your PTIN number or not when you registered, don't sweat it. We're going to cross-check and cross-reference with our records to see if there is a PTIN on file. If there is, we'll go ahead and file it for you so you have it there. So again, thank you everyone for attending. I hope everyone has a great holiday, and most importantly, let's have a real successful upcoming tax season. Thank you.
Thank you, John. Bye-bye.